G'day, welcome to the Financial Bloke Podcast, the podcast for people seeking the wisdom needed to grow their family's wealth and live a happier, healthier and more prosperous life. My name's Ben Law and I am the Financial Bloke. G'day everyone, welcome back to the podcast. Today we're going to be doing things a little bit differently. It's going to be a solo episode and it's also going to be a bit shorter. I'm going to be talking about end of financial year because it's coming towards us really quickly. And I'm going to go through some tips and traps to avoid when planning for the end of year tax with your accountant. So before we get started, we've got to keep the lawyers happy, and I have to give you a disclaimer. So here we go. The information contained in this podcast is general in nature and for education purposes only. It's not financial advice, it's not legal advice, it's not tax or accounting advice. You should not act on the information without appropriate specific advice for your particular circumstances. I'm a former financial advisor but choose to no longer be licensed and cannot and will not give you specific or personal advice in this podcast. So now that that's all done, let's get cracking. Profit, and hopefully lots of it, is everyone's goal. However, the sad fact is the more profit you make, the bigger the share the tax office will be after. The thing you need to work out is how much of your hard-earned cash do you actually need to give them, and how does that fit into your family's business plan? It makes sense that your goal should be only pay your fair share, no more, no less. As I said in the intro, I'm going to share with you my 7 key tips when tax planning with your accountant prior to the end of financial year. Number 1, always remember that there's a massive difference between profit and cash flow. Profit's on the books, and that's the stuff that your accountant and the tax department care about. Cash flows is what pays the bills, and that's what you and your bank should be worried about. Just because you don't have any cash in the bank doesn't mean you don't have a profit and tax to pay. So many businesses have suffered unnecessarily due to unplanned tax bills and no cash in the bank to pay it. Number 2, speak to your accountant about how to take advantage of a lean year. There might be some tax planning your accountant can do to help you take advantage of a bad season right now that will pay off this year, but also for years to come. An example of that might be to bring back in some pre-existing farm management deposits or FMDs, or also historical forced sales. Number 3, know that banks hate ATO tax debts. If you're about to review your lending to say renew a facility or borrow more, then an ATO debt will almost always damage your chances. Always plan to minimise the chance of an ATO debt occurring, especially if a loan review or increase is on the horizon. Can you imagine going to your bank to borrow more money and they say, sorry, but we can't lend you any more until you pay the ATO back? A lot of people fall into the trap of, say, getting a tax bill and then going and saying, well, look, we've negotiated a payment plan with the tax department and we'll pay it over the next 2 or 3 years, which you do see quite often. And then all of a sudden that can have a significant impact on your ability to get more money from the bank. So my rule of thumb is make sure you don't have those tax debts if you can help it. But as a big caveat, before you pay off those tax debts, make sure you speak to your accountant about if that's the appropriate thing to do. And that's a really important point. Number 4, get advice on whether a tax-deductible contribution to super is a good idea for you. Part of the objective of your ag enterprise is building your family's wealth, and superannuation is a great tax-effective way of building up off-farm assets. Now, the number one reason most families build up their superannuation is to help facilitate succession plans. So have a look at super, get the advice before you do it to make sure you do it in the right way, and seriously consider whether that will suit your family's needs. Number 5, check whether an FMD or a farm management deposit will work for you. FMDs can be a great way to manage your tax liability, however, only if it's part of the bigger business plan. What a lot of people seem to miss is having a conversation with their accountant when the FMD goes in on how they're going to bring it out. The last thing you want is an FMD ending up a short-term band-aid that will come back and bite you on the proverbial backside later on. Number 6, if you run your business in a family trust, make sure that you complete your annual trust minutes before end of financial year. Otherwise, it might lead to an absolute nasty tax surprise down the track. Where I see a lot of people run into trouble is they're not actually sure what sort of entity they're running in, whether that's a sole trader, a partnership, a company, or a trust. Now, you need to ask your accountant, what's your operating entity? Do you have a family trust? And if you've got a family trust, you need to make sure these minutes are done. Now, you might have a company, so you might be ABC Farming Proprietary Limited, but within all of your entities that the accountant managed, there could be a family trust in there. So double check with your accountant whether you have a trust and just make sure those minutes get done. So just to be really clear, this point is actually on the ATO's radar. They've been talking about it for years. They're looking at it in audits, and it's a really easy one for them to catch you out on. And finally, number 7, nothing should come as a surprise, especially when it comes to tax. You should know your business better than anyone, and part of knowing your business is ongoing tax planning with your accountant. Don't ever leave planning right until the end of financial year. My advice is do your March BAS, have an appointment booked with your accountant, and then start the planning process, even if the season's not being kind to you and you're not necessarily expecting any profits. Because as we've spoken about already, a lean year might also be a great opportunity for you to do some planning for the future. So here's a really quick summary of those 7 tips, just so you can write them down for when you have your meeting with your accountant. Number 1, there's a massive difference between profit and cash flow. Just because there's no cash in the bank doesn't mean you haven't got a profit. Number 2, speak to your accountant about how to take advantage of an absolute lean year. Number 3, banks hate ATO tax debts. Be very wary. Number 4, consider a tax-deductible contribution to super and whether that fits into your business plan. Number 5, check whether an FMD would work for you. But remember to always consider how you're going to get that FMD out later on. Number 6, get those annual trust minutes done before the end of financial year. And number 7, nothing should come as a surprise. Get planning early. Don't leave it till June. And even if it's a lean year, make sure you have a chat with your accountant anyhow. So that's it for this week. Thanks for listening. If you've got any questions, send me an email, ben@thefinancialbloke.com.au. If you're enjoying the podcast, give us a rating on Apple or Spotify. Like us on the socials, that would be amazing. But above all, if you could share it with your family and friends or anyone you think that would benefit from these tips. That's it for this week. I'll see you in 2 weeks' time.